Everyone, good afternoon, good morning, good day. This is session 9 of MOOC 8, digital currency and cryptocurrencies and financial institutions and financial services. Hope everyone is doing wonderfully today. We are all in a very good mood here at the program at the University of Nicosia because of last week, where we, on Thursday and Friday, held Decentralized 2017, which was the first time we've gathered everyone together for an in-person conference. It was a really exciting success. We had 45 to 50 speakers, over 500 participants. It was the first time that many of us in the program and around the program had a chance to actually get together in one place. The faculty, the students, the graduates, our corporate partners, and just other people interested in the space. So it was really awesome and a lot of fun. And I think everyone is on a high after that. I want to give you a heads up that we will be running it again next year. That's why it was Decentralized 2017, and next year it'll be Decentralized 2018. And so on every year after that. This is going to be our flagship event that pulls together our community. And so tentatively hold November 7th to 9th open in your calendars, and there'll be more announcements coming soon. The other exciting news for you, we have taped all the sessions, and in a few days, once we have them all edited, we will make them available online so you can watch them. So there's great speakers, great sessions from speakers, and awesome panels, and there's a whole mix. I mean, there's some that are more academic, some that are more general, some that are more technical, some that are more corporate. So it's a full 2 days worth of footage that we'll be making available in the next few days once the team has had a chance to catch its breath and edit the footage. So just wanted to take a moment and talk about that, because I think it's going to be an amazing resource to all of you, and you'll get to see some of the best speakers in the world. I see in the chat people want to know where we'll find them. We will be sending out a link once. We'll have them all up on YouTube, I think, most likely. And once they're there, we will send out a link to everyone so that you can watch them. So, and tentatively hold November 7th to 9th open in 2018, because we hope to have some of the people in this MOOC this year at the conference in person next year, just like has happened this time with Decentralized 2017. All right. With that, I'm going to answer some of the questions that came in, and then we'll see what else we want to talk about. With the rise of new cryptocurrencies that can be used to purchase assets, will this introduce sufficient liquidity over the long run to make cryptocurrencies viable as a payment mechanism without the need to convert back to a fiat currency? This is a great question. It is one of the big outstanding questions for the space. And there's a spectrum of opinions on this topic. So the full enthusiasts, the most bullish case, are folks who think, let's say, Bitcoin, for argument's sake, actually becomes a full-blown global currency. The market capitalization of it goes up another 1 or 1.5 orders of magnitude. It becomes not a $100 billion currency, but a $2 trillion currency, a $5 trillion currency. At that level, it is likely to be significantly less volatile. And then it becomes a transactional currency in and of its own right. And that's one view of the world. There's, I think, a little question mark of that necessarily makes it a transactional currency. So, for example, gold already looks like that future, right? Like, so gold is a $8 trillion market capitalization, and the market capitalization is not the right word. It's not a market, it's not a capitalization, but the value of all gold, depending on who's counting, is between $5 and $10 trillion. And despite that, people don't tend to use gold as a unit of account, right? Like, no one says, I am going to book a vacation to Italy this weekend, and I'm going to pay in 1 ounce of gold or 1.2 ounces of gold. Even though gold is sort of not that volatile for a commodity and definitely has a big market capitalization. You know, people, when they're holding gold for monetary purposes, are holding it as a reserve asset, as a diversification asset, and so on. So it doesn't necessarily mean that even if, so I guess what I'm trying to clarify here is, even if Bitcoin or any other cryptocurrency ends up looking like gold, becomes a multi-trillion-dollar asset class, it doesn't necessarily become a medium of exchange because, and or unit of account. Doesn't mean it won't be, but it doesn't necessarily mean it will be. Let's put that in bucket 1. Bucket 2 could be actual, and I know this is not what the question means, but I'm going to say it anyway, fiat or national or sovereign currencies that launch a crypto version, you know, the crypto dollar or crypto euro, that people can use online. And if they can use it online, the transaction costs of going in and out of fiat drop dramatically, right? Because you can have decentralized exchanges the way you have for crypto to crypto. And so that could be a future where this effectively happens even if you're using a different national currency as a unit of account. So once you can, the sticking point in the ecosystem are the on and off ramps from national currencies, right? Because those are not natively digital currencies, they're not natively internet currencies. And so you want to get your money into an exchange, you're going to a bank and you're wiring money to another centralized company and so on and so forth. And that slows down the whole process. So if you have native crypto national currencies, that actually changes the dynamic a bit, and they can be traded back and forth in a decentralized manner the way you have trading for cryptocurrencies. The third is that someone makes a cryptocurrency more suitable for transactions that's somehow more stable or so on. It's a tricky question. I mean, and a lot of people are trying. There's stable coin now that just got financed by Andreessen Horowitz and others. I think it's a very difficult problem unless you are, in fact, the issuer of the currency backed up with unlimited resources like, you know, a Federal Reserve. I think a stable coin is going to be challenging to handle in the long run. And then there's kind of the final version of this. That's a mixed environment where there are a variety of crypto private currencies and crypto national currencies, and a lot of machine-to-machine transactions. And then all of this becomes kind of algorithmically rules-based, and people might be keeping certain assets in crypto and using them to, in fact, make payments and come back to crypto and still keep a big chunk of their assets in this area. And I think that's probably the most plausible. Now, it doesn't mean that they become the unit of account, but it might very well mean that people do some X percentage of their transacting, or machines on their behalf do some X percentage of their transacting in this space. But just, I guess what I'm saying is the space might not exclude fiat currency, because by then you might have digital or crypto fiat. mean, if you think about one of the underlying hypotheses I think most of us here on the program have is that machine-to-machine transactions are going to be happening on natively digital currencies. I don't think there's any question about that. And so whether those are private or sovereign to be determined, but I don't think the machines are going to be going and sending wire transfers or SEPA transfers or ACH transfers out of their bank. They're going to have to work on a full digital stack. And so you can imagine in that case, if it's automated, the machine's using a bundle of currencies for different purposes. Here's what I'm doing to store, and here's what I'm doing for transacting, and here's how I'm mixing all these things together. So I think it's an open question. I think the question is a little bit more broader than it's described. Certainly some people might imagine a world of Bitcoin end-to-end, and that's that. But I think we will see a more mixed environment. And so if I had to guess what this is. So that's first question. Second question, with the rapid increase in Bitcoin price, there is no incentive to spend it, but rather hold on. Without some price stability, I don't see merchant adoption rates increasing in the near future. Without stability in the near term, the most compelling reason to own Bitcoin or any cryptocurrency is the investment potential. This will minimize growth in daily transaction numbers. Do you agree? No, I guess is my answer, because I think the basis of the question, I mean, this is literally the most common thing I read about Bitcoin that I disagree with, which is, well, why would anyone spend it if it's going to go up and down? And let's say you're sure it's going to go up and down, which I don't think that's a sure thing, but let's say you are sure. The only reason to spend, to me, holding Bitcoin and spending Bitcoin are completely different usage cases. And so we all love to talk about the 10,000 Bitcoin pizza, right? The legendary pizza. And people say, oh my God, or how crazy that person spent $75 million now on that pizza. But that's not exactly true, right? Because he could have spent 10,000 Bitcoins on the pizza and then proceeded with an extra, $20 to buy back 10,000 Bitcoins. So what that pizza decision was A, use 10,000 Bitcoins as a medium of exchange to buy a pizza, and B, reduce his asset holdings of Bitcoins by 10,000. And while it's convenient to think of these things together, it's not accurate, right? Particularly with the fact that this is software programmable and exchanges offer these features. You could have something that says, I am going to use Bitcoin for this transaction, and automatically any spending I do will be replenished by buying more Bitcoin. And so then, okay, that sounds fine. I guess you could do it, but it sounds like a nuisance. And why would I do that? And the answer is, the same answer is, why would you do a transaction in Bitcoin in the first place? There has to be some reason why that transaction makes sense to be done in Bitcoin. Let's say you want to send money very quickly to, from New York to Nigeria. You can only do that in Bitcoin. You can't get there in an hour using a traditional financial system, right? And this whole idea that people, consumers, are going to use Bitcoin for transactions just because never actually made any sense to me and has not played out that way, right? Like, this is exactly what hasn't happened, because unless there's some compelling reason to use it to do a transaction you couldn't do otherwise, today it is more convenient to pay with a credit card. Right? Take the card out, swipe it, you get points, blah, 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 blah. Right? Like, why wouldn't I do it that way? And likewise, kind of the flip side of what's embedded in here is, well, without stability in the near term, the most compelling reason to own Bitcoin is the investment potential. Well, arguably, the only compelling reason to hold Bitcoin is the investment potential, right? Like, there's no even in countries, even let's say I am going to China, and I know I need some yuan to transact in China because it's a country where you must transact in yuan. First of all, there's no such country for Bitcoin, but even in China where there is some country, I only take the minimum amount of yuan I need in order to transact. I don't also hold $20,000 in yuan because it's fun. If I wanted to hold $20,000 in yuan, I would hold it because I thought the yuan would appreciate, right? There's no other reason to hold it. People don't just swap in and out of currencies. Regular people don't swap in and out of currencies for fun. Right? This is viewed as a nuisance, kind of the EU going to the euro and not having to change francs and marks and what have you. No one thought, oh gosh, this is really terrible. I really enjoyed having to swap currencies at the border and having to pay transaction fees and so on. Nobody liked that. Everyone thought it was better to go to one currency for transaction purposes. So to me, there are two independent usage cases for Bitcoin, and they should be thought of that way. The one usage case is for transactions that it is somehow better to do in Bitcoin. And we'll come back to that in a second. And there's some, but not all. And the second usage case is because you think for some reason it is a good investment asset. And that reason might be because it's decorrelated with other assets, or because it is, under certain circumstances, hard to confiscate, or it's because maybe it is actively negatively correlated with certain scenarios you're worried about, and therefore you want to hold it as an investment asset. If you want to think about this, I think absolutely clearly, you could say, I am going to buy 10 Bitcoins as an investment asset. It's a lot, right? $75,000. And I'm not going to spend them. No, they're just there. I have my 10 Bitcoins. And then I'm going to buy, I don't know, a tenth of a Bitcoin, $750 as of today, in order to have my transactional wallet. And if I need to spend money, I want to buy my famous coffee or TV in Bitcoin for $300. I tell this I could keep in an online wallet. It's not a lot of money. I'm not worried about losing it. And I can even say, like, hey, Coinbase, every time I spend $200 with this thing, buy $200 more. So there, spending Bitcoin does not actually change your overall investment holdings of Bitcoin, because you separated them into two buckets. Now, that might sound like a bearish case on Bitcoin. I don't think it is. I think the investment case for Bitcoin as a reserve gold asset is interesting. As we know, we don't give investment advice here, but it's certainly interesting. It certainly has shown to have some resonance in the marketplace given where the price has gone. And the transaction case exists, but it is not the base. I've never thought it is base consumer transactions. I've never thought, oh my God, the thing that is missing from my life is I need to go buy myself a coffee here on campus and I should do it in Bitcoin. But there are cases. I even had a case happen to me at the university last year. We had one of our recruiting team was in Zimbabwe and had a very serious accident with an elephant, actually, and was very seriously hurt. And we needed to medevac her right away from Zimbabwe. And there was, in hours, not weeks, there was no way to, and the plane that was going to medevac her said, well, that's great, but I need the money beforehand. Well, let me tell you, at 11 p.m. at night on a Tuesday, there is no good or fast way to get money from Cyprus to South Africa. The fastest way is, wait till the morning, go to the bank, and take 2 or 3 days. And we didn't have 2 or 3 days. We had hours in order to get this done. And You say, okay, well, why don't you use a credit card? Well, they didn't want credit cards because I think they're afraid you might reverse the transaction. And so they didn't want to fly the jet to Zimbabwe and then risk you. And so eventually we had to find someone to put up a guarantee effectively, and we were able to do what we needed to do. But it would have been the perfect case for Bitcoin. I mean, it would have been absolutely perfect. They could have said, right, I need to get you $10,000 now. You need to know that I'm not going to renege on my commitment. I am going to push $10,000 to you, and you will have the first confirmation in minutes. You can start planning your medevac, and you will know you have the money for sure in an hour, and then you can actually execute your medevac. So I know this is a little bit of a complex example, but it has the interesting fact that it actually happened to me. This was actually a problem I was trying to solve last February, or this February. I was like, I mean, I can't believe it. This is actually the usage case, or a usage case for Unify. Same thing's going to happen for machine-to-machine transactions. They're definitely not going to run through the traditional banking system. And all types of other transactions, remittances and so on, where the payment channels aren't very good right now. Unsensible transactions, remittances, and there's a series of usage cases. In time, back to the prior question, if all this stuff gets managed and volatility gets managed in the background by your wallet, then you might come around and start using them also for some retail transactions in, let's say, advanced market economies. But even there, I'd imagine it's more useful for programmable money. Like, I want to send $500 to my kid in college, but I want it tied to spending on books and something else. I don't want my son going and just buying a bunch of beers with it, right? So the ecosystem's still very immature for that yet, but you can see that type of thing happening. So that was a very long-winded answer to this question, but I think it's an important topic, and because it comes up over and over and over again. And my view is these are holding any cryptocurrency as an investment and using any cryptocurrency for a specific transaction are completely separate activities, even though people tend to mush them together and then get themselves all, concerned with, oh my God, many people over the last few years have said, oh, well, look, merchant adoption is not going up. I guess this didn't work. And then we're very confused because the price kept going up, right? Also, the dollar volume of transactions moving through the system has gone up, even though the number of transactions has not gone up as much. And so this pushes a little bit towards Bitcoin as a settlement network, but that's a whole different story. All right, I'm going to cut myself off on this because I think I've covered this one well. There is a related question. Someone submitted a transaction on Friday. It arrived on Monday. Bank transactions cost more, but I have the option to call them in case something goes wrong. Is this something that will keep cryptocurrency adoptions back? In a coffee shop, would I still be waiting for the payment to confirm, or would I have to pay using cash and hope they will refund me when the blockchain transaction eventually clears? Well, certainly I don't think this is the useful usage case. Pay with cryptocurrency, ask for a cash refund. I mean, that's a disaster. Look, I suspect the reason it took from Friday to Monday to confirm was the fee was too low for the blockchain that this transaction was done on. If it was on the Bitcoin blockchain, the fee wasn't high enough to get confirmed quickly. However, I don't view, as we just mentioned, Bitcoin transactions as being primarily for low-value instant retail transactions. I think we will see those transactions either in sidechains or things like Lightning or other cryptocurrencies optimized for speed or intermediated by merchant processors as they are done now for credit cards, right? Credit cards seem to transact instantly, but they don't actually. Settlement takes several days. Settlement for credit cards is actually slower than settlement for Bitcoin. It just doesn't feel that way. It doesn't feel that way because the network steps into the breach, makes a risk-based decision, and decides to approve the transaction or not based on a risk-based decision. So it is absolutely not the case when I go and buy a coffee with my Amex that somehow in those few seconds that the payment is approved, the money has come from my account and ended up in the coffee shop's account. All that has happened is based on the metrics and the metadata associated with that transaction. The credit card company says, yep, we are good to extend credit to Antonis for another $2.32 at this point in time. And we think it's actually Antonis, and we think this is a legitimate transaction. And so go ahead, merchant, give him the coffee. And by the way, if you, merchant, did something wrong, we're going to take the money back. And by the way, we hope Antonis will pay us off, but we're not 100% sure we will. So it's risk-based. You could easily imagine if you have a world of B2C cryptocurrency player payments, that you will have these risk markets emerge there. So if I'm Antonis Polemitis, I have a sterling record of not trying to double spend my coffee because, seriously, the amount of effort you would take to double spend your coffee far exceeds the value in double spending your coffee. You could imagine from the moment that I broadcast a transaction that some intermediary, in exchange for a merchant processing fee, will say, yep, give him the coffee. I will cover you if for some reason this $2 transaction doesn't go through. And that's going to be risk-based. If it's a $100,000 transaction, you might say, well, you know what, let's give this, let's see a few confirmations on this before we move forward. Now, the good thing about this is most transactions you need speed on are small, right? There are very few things you're going to go buy for $100,000. It's 1 or 2 minutes, and you walk out with a $100,000 good in your hands. Right? I think only jewelry. I can't actually think of anything else. So it's not like you're walk into a car dealer and expect that 60 seconds later you're walking out with a car, right? So the things that are fast, instant, tend to be low-value transactions, and those low-value transactions are going to absolutely be amenable to risk-based pricing, risk-based confirmation. So again, all my prior comments on why do I want to use Bitcoin for this transaction in the first place still hold, but if low-value, high-speed retail payments will emerge, it's going to be either this risk-based approach or places where it's become risk-based effectively through things like side channels, right? So they're secured at the overall level, but not at the transaction level. You're extending a little bit of trust. And this is yet another variation of the heart of the debate right now on Bitcoin is what is trust and where does it matter, right? And effectively, the small blockers are saying the important thing is to have trust at a settlement layer, even if it's slower, even if it's more expensive, have a core underlying architectural layer that the foundations we absolutely trust, and we can give up a little bit of trust on smaller transactions. And the big blockers kind of have not really the opposite view, but more towards the opposite view, that the same layer of the chain can handle big and small transactions, and we shouldn't separate them. So it's a big question, and it underlies some very complex topics. And I do think the mechanism by which a $2 transaction is going to happen will ultimately be different than a $20 million transaction. Our existing system has evolved that way, and I'll be surprised if this doesn't end up in that environment ultimately. Okay. Gold futures hold virtually low gold value. What will happen to Bitcoin with the launch of BTC futures? Well, I'm not sure that's accurate, first of all. I think the futures market is a good thing for Bitcoin as a whole. I think it's an excellent sign of maturity as an asset class, as a commodity. All legitimate assets have a futures market. It is not likely, in my opinion, that the futures market will diverge from the physical settlement market, because the physical settlement market in this area is digital anyway, so it's very inexpensive to physically settle. And if it diverges, it's free money for someone. And free money arbitrage opportunities tend not to stay around very long in financial services, particularly when they can be arbed digitally, right? Like with oil, if there is a divergence from the financial market and the physical market, the way you can absolutely force a conversion is to take physical delivery of, thousands of barrels of oil, but that's annoying. So you have to put it somewhere. You can take physical delivery of Bitcoin very, very trivially. So I believe this is going to open the door for quite a few further developments. It certainly is going to open the door for the quote-unquote institutional money, right? Because what they're doing is trading with counterparties they already have the systems to trade with. So unlike the vaguely terrifying idea of how do you trade physical Bitcoin directly with all of the attendant security issues surrounding it, which is, it's a big issue, right? Like this is, I would not want to be the person who tells my IT department at a big bank, manage Bitcoin wallets now, And by the way, if someone makes a mistake, millions of dollars are going to go out the door, or tens of millions, or hundreds of millions, and no one's going to reimburse you. So I think a lot of institutions are going to find this ability to take long or short bets, both, without having to change their existing trading infrastructure, to be super, super useful. And I think everyone in the cryptocurrency community should welcome it. The fact that people can now more easily put short bets, so what? That's true of every asset. So it can't be the case that one believes Bitcoin is worth X, but oh my God, don't let someone short it. One really believes that it's worth X, we should encourage shorting because it's another way to make money. Also, it is a precondition for some broader products. One of the reasons the Bitcoin ETF was rejected earlier was that there was no futures market in this asset class. And part of the value of a futures market to an ETF is to help maintain balance with the underlying asset class. And so I suspect once CME starts actively trading these, everyone's applications on everyone's applications for ETFs are going to get sent in again, and people are going to try again. So, I mean, to me, this is all positive. It is the type of thing that 3 years ago, 4 years ago, everyone would be daydreaming about. Oh, how do we, well, not everyone. Some people want the financial system, the existing financial system, out of this picture completely, but I think that's not sensible. There's no reason, there's no way that cryptocurrency lives up to its full potential without interaction with the existing financial system, without interaction with the existing pools of capital. And I am not in the bucket of believing that speculators are a bad thing. People need to trade financial assets for there to be markets in financial assets, for there to be liquidity in financial assets, for financial assets to have deeper, more stable markets. The daily trading euro dollars is in the $5 trillion a day range, which is why spreads are low, which is why volatility is low, which is why you can transact large amounts of euro dollars without moving the market. If Bitcoin or any other crypto asset is going to have these similar characteristics, it needs a lot of speculators, a lot of traders being there making bids so that people who need it for operational purposes have a counterparty to trade with. So I consider it all end-to-end positive. As always, I have no idea how it's going to impact price, nor do I care. I think it is a positive evolution for the asset class. A couple of questions we've had before. I'm going to just run through them very quickly. If governments adopt their own digital currency for use in their borders and ban the use of digital currencies, how will it affect the dynamics? How will it affect the price? Depends, I guess. You know, how many governments do it. You know, I think they're relatively resilient, but not 100% resilient. You know, if every single country in the world said tomorrow, you will all be executed for using a cryptocurrency, I think that would be negative for price, right? But if China, which was a huge market for Bitcoin, says, oh, let's shut down our exchanges, but there is a sufficiently open environment in Japan and South Korea, we saw kind of demand rerouted to Japan within a few weeks. So one country here or there going on the attack against, let's say for argument's sake, Bitcoin, I think is not going to be enough to derail it. If there was a coordinated attack, I think it would be enough to derail it. But I think people's or national or corporate self-interests are going to make it hard for a coordinated attack. I mean, if I was in charge of a cryptocurrency, I would be very happy to see a bunch of institutions starting to trade it, starting to use it, starting to create financial products in it, because now you're developing a political constituency that doesn't want it to go away. And so the dynamic I think a cryptocurrency wants is that if one country tries to push against it, another country says, oh, wonderful. This is an opportunity for me to pick up market share in this financial service and be able to make money doing it. And so the more that dynamic gets embedded, I think the harder it's going to be for a coordinated multinational attack on cryptocurrency. But, you know, I mean, there are no absolutes in life. If everyone got together, if all the nation states did a very coordinated attack on cryptocurrency, I think it would have a very big impact. Wouldn't go away, but it would have a very big impact. You know, right now, I read last week, Coinbase after the CME announcement, added 100,000 users in one day. They were previously adding 30,000 users a day. Well, look, this is a source of inbound demand pushing the price. If those people said, yeah, someone shut down Coinbase, it would be harder in the United States, at least, to buy cryptocurrency, and that would have a price impact. So nothing is absolutely resilient to attack. But the question is if it's coordinated or not. If it's not, I think demand will find a way to flow to the asset class to the degree that there is demand. There's also another question. I think we've touched upon these issues before, that it's once block rewards cease and Bitcoin becomes naturally deflationary, and there are lost private keys, would there be interesting to have a mechanism to put these coins back in circulation? Let's say if there's an unspent transaction for over 50 years, could we make these coins eligible to become block rewards at a set rate? I mean, I'm not sure it matters. And anything that is, because the problem is it hurts in the case of Bitcoin in particular, people saying, oh, I want this as a secure asset class. I want it as a hedge on other things. Anything that is remotely short-term, and if you don't move your money for this amount of time, we're going to come seize it, plays against that usage case. And if it's 50 years in the future, I do believe it is outside the horizon of which this is going to matter anyway. Long before 50 years in the future, it's going to be clear how this space has evolved and how miners are being compensated, including if we've moved on to completely different mechanisms altogether. I mean, 50 years ago was 1970 approximately. That was when the card networks were first starting to get built out. I think 1967 is when it first started. So, the world 50 years from now, with an accelerating rate of change, it's very hard to say we're going to sit here in 2017, make design choices that are going to make the world in 2067 more viable. I think we truly have no idea what the world of 2067 is going to look like. Another question says, could the trust in financial institutions be also referred to as lack of alternatives? I guess. I think it's important to say the following. Trust in financial institutions usually goes to a level, ultimately, of trust in the governments of the country that the financial institutions are in. So, part of the reason you feel comfortable having $50,000 in a U.S. bank is you feel comfortable that even if there's a problem with that bank and there's a bank run, that the FDIC is there and will refund your money. And we saw this. We saw people get a little shaky in the 2008 crisis for amounts above the FDIC limit, and it got temporarily doubled to keep people calmer. But it was still kind of the first time in modern American history that people started thinking about their balances sitting in American banks and saying, oh, am I comfortable with this or not? And before deposit insurance, there were consistent bank runs because it's fairly easy to start a bank run in that type of environment. And what is the ultimate lender of last resort or backer up of last resort of financial system, I think plays a big role. The exact same system in the United States and Venezuela leads to very different trust in the financial system, right? So, and the difference isn't that checking accounts work differently in Venezuela, it's that people don't trust the fiscal and monetary policy of the Venezuelan government. So, I think that really has to do with the government more or less as being the underlying backstop to the financial system. It's very, very rare. Let me put it differently. It's very, very rare to see financial institutions rated more highly than the sovereign ratings of the countries that they're in. The general view is that if you're investing in a bank, if you're lending to a bank, you are taking on both the sovereign risk of that country plus some institution-specific risk. It is rare to think that you can invest in Bank X or investment bank Y, and the risk there is less than that of the country that they are located in. So I'm sure there are examples where it's happened, but they're highly unusual. So I think this really has to do with, do you trust a certain government? And there is a spectrum of how well governments are managing their finances and their financial services sector and their central banking policy and so on. And so again, nothing is an absolute. Right? It's all a spectrum. It's all shades of gray. When you look at credit ratings, it's not like people are rated good and bad. You have everything from AAA all the way down to unrated whatsoever, where people aren't willing to put a rating on it, and everything in between. And this has to do with people's best estimates at any point in time of how trustworthy a certain institution is. This covers the questions that came in advance. We have about 10 minutes. I'm going to try and put another topic in the air, which there's no answer. It's me asking a question back to you. And I'm going to go by analogy here. In the early days of television, the television shows were basically radio shows with a camera in front of them. So it's kind of what you have on the radio, and then you just point a camera at people, and you're having a radio show, but with video. And it took some time before people were able to break out of the framework of what do you do on radio and think, how do you use this new medium? Hey, Mark, I'll try and speak up. I believe with cryptocurrency, we're in the radio on television phase. So what are most firms being built in this space? Most of these firms are the crypto equivalent of the traditional financial sector equivalent. So an online wallet is basically a bank account. A merchant processor is exactly a merchant processor. Not even basically a merchant processor, it's a merchant processor. Exchanges are exchanges, and so on. And so these things are necessary, I suspect. They're infrastructural level, and they're important in the first phase, but they're not the major innovation. And it's why we're saying, well, gosh, is this going to replace this exact part of the existing financial system? And I don't know, it's a little bit better, it's a little bit worse. I'm more interested in the new models that are going to emerge. And they are, I think, starting to trickle in. I'm going to give you an example. To me, one of the most interesting things I've seen in the bucket of financial services and cryptocurrency is a firm called Numerai. Numerai is a hedge fund. Now, if you're launching a hedge fund in 2017, in most cases, you're going to be doing a lot of quantitative analysis. And to do quantitative analysis, you are going to need data scientists. And if you're a good data scientist for at the level of making good predictions for a hedge fund, you are going to be very popular. People like Goldman Sachs and Fortress are going to be willing to pay you a lot of money to come work for them. So if I'm launching a new hedge fund and I want to compete with those guys, you're just not going to be able to do it in the normal way. You're not going to know I'm going to pay you more or I'm going to hire more data scientists. It's literally impossible. Why would there be any reason to believe that you can pay more than people with big existing large multi-billion-dollar hedge fund businesses? You can't. You can't pay more and you certainly can't hire more. Maybe you could pay more for one person. So what did Numerai do? Numerai said, well, I am going to open this up. I'm going to take my data sets. I will blind them. I will make them available for people to make predictions on them. So you don't know what the data set is, but you see a series of numbers. I'm going to predict what the next numbers are in the series. And I'm going to give a token that goes along with this that you can earn for your predictions and then stake with your predictions. So if you're very confident in your prediction, you can put more of these tokens down. And I think they're about 2 years old now. And they have had something like 1 billion predictions made across their data sets and 30,000 data scientists who have made these predictions, who they have then compensated with their token and has generated a certain value. This, to me, is much more interesting because this is literally impossible without cryptocurrencies or public blockchains or what have you. They're just impossible. There is no way to do it in the traditional financial system. There is no way that on a fee-for-service basis, you can, a 2-year-old hedge fund or a 20-year-old hedge fund can hire 30,000 data scientists and pay them based on performance. And so these, to me, are the models of the open financial systems of the future that look more like networks, that are more decentralized. Now, the hedge fund's not 100% decentralized. It's actually someone who owns the hedge fund. But I thought it was very, very interesting. It was one of the first things I've seen in pure financial services that I said, this is literally impossible to do in the existing system. And the people who figure these things out early are the ones who are going to make amazing businesses. I mean, truly amazing businesses, where everyone's going to look back and wonder a few years later, and say, wow, how did that happen? Where this came out of nowhere. And so one of the things I'd ask all of you to think about, if you're thinking about this space, to take 2 dimensions, right? The more obvious dimension is what's happening now. Like, Coinbase will be a very valuable business, right? Anything that's has the transaction volume it has, it's going to be valuable. And there needs to be a Coinbase in the US, and there needs to be a Coinbase in Indonesia and everywhere else. So there's port existing financial infrastructure onto the decentralized world, and that's a good idea. And I think their execution is primarily what's going to win the day or not, because the business models are obvious. They are cloned from the traditional world. And then in a completely different dimension are network models of financial services that don't exist in the traditional world, can't exist in the traditional world. We've never thought through them in the traditional world. These are going to be the more interesting financial services, and by definition, harder to think about in advance because we are still in the box, in the frame of radio on TV. It might be the case that I'm too old to ever think of one of these, right? Because I've kind of spent my whole career looking at the traditional financial sector as it is. And so I'll be honest, I never crossed my mind to say, oh yeah, I'm going to do a hedge fund and I'm going to make my analysis of my hedge fund an open source contest, in effect. And I think we're at a point of maturity in the space that more of these topics are going to start appearing. And I want to encourage people to think about it. It's where it gets super interesting. Right? And I'll finish with what's the analogy for the internet. Like in the early 90s, everyone knew, yes, it was just a matter of time, but everyone knew you'd be able to have like articles on the internet, or even, wow, streaming video on the internet. I mean, assume that bandwidth increased 100 times, you can do streaming video. And yeah, wow, even commerce on the internet. All of these were non-internet business models ported to the internet, and some of them were very successful. Amazon, Netflix. But no one imagined Airbnb, right? Airbnb was a model that depended on the internet, couldn't have existed without the internet. And the idea that there's going to be a global network of hotels without a hotel where people are going to come sleep in people's homes, no one even thought that was a good idea. Not in 1993, not in 2003, not in like 2010 or wherever they started. And so these are the kind of next generation of financial services models that will emerge here, that people need to look at it with a very fresh eye. And I'd love to see more of these. I think that's where it gets really exciting. That's where cryptocurrency will live, and blockchains and these network models will live up to their full potential, because they will enable business models we don't see today in the current world. So I will leave you with that. It is exactly 1 hour. I don't see any other relevant questions in the comments. So I think with that, we can wrap up for this week. And we will be back next week with the next session. Okay, everyone. Thank you very much.